What's up, clan? Island Trader FX here. Um, in truth, I think I've tried to make that video like at least 8 or 9 times. But anyways, we're here back with another one. The scenery is different. We're at the beach, but nevertheless, we remain on the topic that we always discuss, which is trading. And today, I just want to talk about slowing your roll, staying in your pace, and staying in your lane where trading is concerned. Trading is something that is very personal, right? Everyone has his or her own journey that they would need to take, right? I always tell people you have a personal relationship with the market, right? The relationship that I would have with the market would not necessarily be the relationship that you would have with the market. Um, I could clearly remember when I first started trading, you know, individuals would, and I would not say what they meant mal or they had bad intent when they said those things. But I could specifically remember individuals saying that trading thing that will not work. My father did it, my friend did it, they lost a lot of money. You know, the thing is, you are not their friend or you are not their father, right? You are your own individual. The way that you would learn something is not the same way that somebody else would learn something. That is why I say trading is something that is very personal. Oftentimes you'll find individuals trying to skip steps and try to rush and place themselves on steps that they should not be at yet. And let me give you a typical example, right? And oftentimes you'll see that with newbies. You could see it with seasoned individuals as well, but you will see that with newbies a lot. If, for example, someone were to make $1,000, right, from trading, a newbie would come around and they would be like, okay, well, this is my goal, and the first trade they ever execute or the first few trades, they're going to try to raise their lot size to make $1,000. But here's what: one, you don't know the individual's you don't know the size of the individual's account, right? Seasoned traders, they know that, hey, if you want to remain in the game, you have to risk at least 1 to 3% of your account per trade, right? Now, obviously, maybe that person would have made that $1,000, but that person would have only risked 1% of their account. But a newbie would come around, try to make that same $1,000 with what, maybe $500 in the account, essentially risking the whole account to make $1,000. Now, let's say yes, you take that trade and that trade plays out, right? Then you now have the idea that every time you go ahead and over leveraging is um putting into the market more than what you can afford. You shouldn't be, if your account is, let me just rephrase that. If your account is $1,000, you should not be risking $1,000. That makes absolutely no sense. If that trade does not go in your favor, guess what? You'd have blown that $1,000 altogether, and now you have to try to recoup and put another $1,000 back into the market. Um, Experience is something that would teach us, and the truth is, some people, you may speak to them and tell them those things, but they will not listen until they actually feel for themselves, and oftentimes they would have to feel over and over and over again, right? So where trading is concerned, you don't want to keep up with the Joneses. You let people do their thing, you take your time, build your account slowly. If you're worried about when to increase the lot size of your account, I would say every time you grow your account 100%, then you could increase your lot size by a little bit. So whether it be 0.01 or whether it be 0.02, I would say the only time for you to increase your lot size, sorry, would be after you would have grown your account to 100%. So when I say 100%, basically, if you were to put in 500 US into an account and you began to trade, when you grow that account to 1,000 US, then you raise the lot size. And it's the same for if you were to put in $100 or $200. When you grow that account to 100%, then you could raise that lot size. But it is very, very, very important to know your place, slow your roll, and focus on your journey where trading is concerned. Remember, you don't know, you maybe see the person come out of the market with a lot of money, right? And you're a scalper. You don't know if the person is a swing trader. Swing traders, I could tell you, they tend to have more patience. They have individuals that don't have the guts to hold trades for so long, right? But then you have individuals who are able to hold for a long period of time. Now, obviously, if you want to be holding a trade for days at a time, right? Swing traders, obviously you want to be coming out of the market with a lot of money, right? So if imagine you're a scalper and then you're looking at the money that someone would have come out of the market with, not even knowing and understanding that that individual is a swing trader. So that is why I say you have to slow your roll and know your place. Everyone could reach the, I would say, the pinnacle. However, there are steps to reaching that particular pinnacle, right? All right. So I want to go over the trade that I took on the screen here. It's a trade that I took on gold. I think TP hit on Monday, right? On Monday, that is when TP hit for that trade. So I just want to quickly just go over that trade. Let's do a quick top down of what I saw and why I took that trade. Obviously, I think everybody and their mother knows that gold has been bullish for a very, very, very long time, seeing all-time highs. Um, Not just gold, but metals on a whole. Just look at that on the weekly time frame. Just look at that. You're just going higher and higher and higher and higher. The prices are soaring, right? So obviously on gold, we want to be bullish. Um, I know for a fact that a market doesn't just go up forever. In order for it to move higher, it has to retrace to the downside and then continue moving higher. The sales I don't want to take. I want to get off where I believe the market will be reversing and looking for the next opportunity to jump in and buy again. So on gold, what did we see, right? On gold, we have a clear weekly PD array in the form of a imbalance. We saw price dip down into that zone. The marking of that imbalance on the weekly time frame is a bit unique. I will go over that on another video, but I waited for price to come into this zone here. Like I always say, it's not about the boxes that you draw. The market doesn't care about the boxes or the circles or the teddy bears that you draw. Everything has to do with price, okay? So this box represents price points. If I go ahead and put a line here, bam, bam. So between those two price points in white, that is where I wanted to see price come into. And of course, when price dipped into that price point, there was a major rejection to the upside. Okay, so from that rejection, I want to go down to my lower time frame and see where I could scale in or where I could jump in for the continuation to the upside. Now, on the 4-hour time frame, we have this rejection in the form of a double bottom. Okay, we could see that price dipped right here. There was a massive rejection, which is what we saw on the weekly time frame. Price retraced, forming the second leg, right? Not going below this first leg right here and pushing up. Okay, we could see this high right here. Price kind of tapped into that high, dropped a bit. Now at this point I said to myself, hey, they already formed the second leg, which confirmed the double bottom, right? That was already formed. So I know for a fact that if the second leg has been formed and right after the second leg has been formed, there was a bit of a consolidation and price already on the higher time frame, well, out 4 hour is high. So I would say on the weekly time frame is still bullish. Then chances are that after that consolidation, the expansion will be to the upside. So when I saw price drop back down, I said to myself, okay, Well, price did drop back down. Guess what I'm going to do? I'm going to hop in because in my opinion, it is a discounted price at this point. So I went ahead, I put my stop loss at this low, right? The second leg of that double bottom. First leg, second leg. So my stop loss was at the second leg of this double bottom. And you know what I like to target? I like to target my daily close, my 4-hour close, 1 hour at times. And this is what I did. I targeted my daily close this time around. If I targeted the 4-hour, the 4-hour would have been here. Okay, not far from the daily. But if I go to the day, this is the daily close right here, right? So this is what I targeted. Okay, it's clear on the line chart. I'll just want to delete that here. And as you can see, price, after it came into my zone, it pushed for a while, and then right after it hit TP, look, literally right after it hit TP, price just melted to the downside. Bam, massive drop. Massive drop. I know the scalpers probably went crazy with that drop, like, oh my gosh. But for me and for other swing traders, or I would like to say some day traders, this massive move to the downside is nothing but a retracement to move higher. Okay. And even currently, I'm looking to see how I could scale into gold again for another bullish run. Okay, but that was it for this trade. Altogether, very beautiful trade. I had to be very patient. I mean, you could count the amount of days as 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's 10 days before price hit TP. Not a lot of people have patience for that, but of course, if you're swing trading, it's a lot safer out there for you. So, at the end of the day, you choose what works for you. But that's it for this video. I hope you enjoyed. If you did enjoy, leave a like, subscribe. Feel free to comment. Ciao.